Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good to have you back today.
Happy to be here.
Well, stocks on Wall Street closed lower overnight. The coronavirus outbreak playing a role there, and maybe investors taking a breather after these recent gains. What's the story in the global markets?
Okay, well, as you mentioned, the U.S. market was up on Monday but down on Tuesday. In fact, the Dow and S&P were down quite a bit. Dow was down by 400 points or 1.5%, and S&P were down by 1.9%. The popular reason for the fall in the market, as you mentioned, was concerns about the coronavirus, doubts about quick recovery. So hotels, airlines, they were hard hit. But they've been saying this concerns about lack of quick recovery for a long time. It's been repeated quite a bit. So I'm not sure how decent an explanation this is. It's probably more likely that the market is very, very nervous, and you have a lot of short-term investors who's out to make a quick profit. So once the market goes up by some degree, they sell it off, they take quick profit making, and they look at chance of doing that again. I think that's probably the more likely strategy that these investors are taking in these very unstable times. As for the other markets, European market seems to be taking the U.S. lead. It was up on Monday, down on Tuesday. They haven't opened yet. Nikkei, they were down all week. Shanghai, they were rising very quickly, but then it plateaued on Monday and Tuesday. Then it rose strongly again today. There has been some reports in the press that the rise in the Chinese market was due to a very large government encouragement, but their Chinese market fundamentals are still not very good. So they're looking for the Chinese investors to move into a safe asset sometime in the very near future, but of course nobody can tell when. Hong Kong market was down on Monday and Tuesday. It rose again. It rose today. And then for our own KOSPI and KOSDAQ markets, KOSPI rose on Monday, but yesterday, even though we had some relatively good news from Samsung and LG, their results were not as bad as the market expected. Even though that was a relatively good news, the market fell on Tuesday and Wednesday. The reason for that seems to be that the institutions and foreigners are selling off their stocks, foreigners especially because of the concerns with the U.S. market. KOSDAQ, on the other hand, there was a slight leveling on Tuesday, but it rose again strongly today.
Now we have the OECD is saying that the global unemployment rate will be worse than the Great Depression by the end of this year, but then start recovering next year. Tell us what stands out to you in that report and as it concerns Korea.
Okay, well, let's look at the global part first. The European countries and U.S. countries are taking different paths when it comes to the unemployment rates. The European countries, the unemployment rate right now is actually lower than where it was in 2008 global financial crisis and the years following that. That's because the European economies have placed emphasis on keeping the employment, whereas the government of the United States or even Korea, they've been looking at protecting the people, but not necessarily protecting the jobs. So if we look at the non-European economies, the unemployment rate is as high or higher than it was in 2008 global financial crisis. Now, OECD has a mixture of European and non-European countries, so their estimates are that if we only have a single hit from the coronavirus, the unemployment rate will hit highest in second quarter. That's actually a bit past, and that's going to be at 11.4%. But if coronavirus comes back, then the highest point of unemployment will be in the fourth quarter at 12.6%. But as you mentioned, things may get a bit better in 2021. But how well it goes depends on well, whether we get only one hit from the coronavirus or two hits. Now, Korea, we're at a level that's about similar to where it was during the global financial crisis as in terms of the unemployment rate. But in terms of hours worked, we're about 11% lower than where it was during the global financial crisis. So we are having a worse crisis than the 2008 global financial crisis. And if under the single hit scenario, the unemployment rate will go up to 4.8% in 2020 and then go down to 4.7% in 2021. If you get a double hit scenario, then it'll go up to as high as 5.1% in 2020, but go down to 4.7% in 2021. Now, OECD makes a lot of recommendations as well. Korea has been very good at following these recommendations, except perhaps one. They recommend a balance between keeping employment alive, keeping jobs alive, and carrying out structural adjustment. I'm not quite sure what structural adjustment we can do right now because the situation is so unstable. But the OECD does not mention what kind of structural adjustment that the Korea should go through.
Well, the Korea is spending a lot of money to help people out during the pandemic. That is causing concerns over fiscal stability. We're almost out of time, Professor Young, but what do you say to that concern?
Okay, well, more and more academic economists are saying while the debt is not unimportant, right now the more important thing should be to help manage the coronavirus recession. So most economists in the academic side, I think right now, favor continuing spending, fiscal spending to try to keep the demand, try to keeping the firms and try to keep the employment as much as possible. And then after the crisis, we can worry about the increased debt. In case of Korea, as I mentioned in past broadcasts, I think we should emphasize on raising GDP, raising productivity so that we can lower the debt GDP ratio through a rise in GDP. But for now, the rising debt should be second priority. The first priority should be to deal with the coronavirus debt, the recession.
Got it. All right, Professor Young, thanks as always for sharing your insights today.
Thank you.